Interest rates in the country have declined marginally by an average of 1% since the introduction of the Kenya Bankers Reference Rate mid last year. However, various economic activities being undertaken by the government are expected to drive interest rates even lower. In its 2015 Economic Outlook report for Kenya, Metropol projects that continued disbursements of cash to finance mega infrastructure projects, as well as the current bill in Parliament aimed at creating a new platform for government bonds, are expected to drive lower interest rates.
The pronouncements by policymakers, they've been calling for a lower interest rate regime. We pointed out that there is even a bill in Parliament for government bonds to be sold in smaller denominations, which means retail buyers, you and me, will be able now to buy treasury bills and bonds.
Nderitu says Kenya is on course to achieve a 7% economic growth this year, noting that about 5.5% economic growth realized last year was not a step backwards, but that the new figure was computed against a rebased bigger economy.
If you use the previous GDP estimate, that figure will be actually more like 6.5%.
The current slump in global oil prices is also expected to lower the country's inflation rate.
The price of petrol and petroleum products is a significant input, so we expect lower inflation because of it, and therefore we expect a smaller current account deficit because petroleum imports are a big component of our importation bill.
He, however, notes that the slump in oil prices will in no way affect oil and gas explorations currently ongoing in the country, since commercial production is yet to kick off.
In terms of making the investment decision, today you are not looking at the price of crude oil today. You are looking at the price of crude oil expected 3 years from today.
Nicholas Nderitu, Business Insight.